What do you think so far, and do we care about the rearview mirror, or is it all about the outlook? I'm interested in the outlook of these companies.
Yeah, I mean, I think it's very early right now, right? Only 16% of the companies reported. You're looking at about 13.5 times earnings growth, so that's good, about 1 percentage point better than people thought. Okay, it's the guidance, though, Joe, to your point. It's been mixed at best. But the interesting thing is, look at the stock reactions. I mean, look at the semiconductors and the semi-cap equipment and the industrial companies last week. Numbers were actually coming down, and the stocks actually exploded higher. And that just speaks to very cheap valuations, very low expectations, which is quite the opposite of what we saw this time last year. Last year, we were expensive at 19 times forward, and we were expecting great earnings. We got okay earnings, and the stocks fell. It's quite the opposite this year.
And suddenly, into the business lexicon is earnings recession. I'm not even sure what that means. It doesn't need to be negative. It just means to be disappointing, I think. Is that how you see it? What does it even mean?
That earnings decline or around zero, but the overall economy has not gone into
No, but what is an earnings recession is what people say when they're not really, they can tell that it's unlikely there's going to be a global economic recession anytime.
Well, 2015-16, you actually did have year-over-year declines in S&P.
Does it have to be a decline, or does it have to be it's no longer double digit?
I don't know.
No, it has to be a decline.
It has to be a decline to be an earnings recession.
It has to be a decline.
And there's no real reason to think that either, is there?
That's why I said, I mean, we're running 13.5% earnings growth right now.
That's from last quarter, though. What about this year?
Yeah, I think that we're probably going to do maybe 4, 5, 6%, right?
That's close enough. That could swing the other way, theoretically, I guess.
I mean, maybe, but I think that the multiple contraction that you've seen in the market in the past year is already accounting for that, right? We're already expecting that. So anything better would be actually a good thing.
The reaction you're talking about, it seems obviously a measure of, as you say, how cheap stocks got, how basically people got back on their heels, not expecting good things from the market. I wonder how far that takes us, right? I mean, it's unclear. You're still 10% from the highs in the S&P 500.
And that's a very good point, and it's a stock picker's market, because just look last week, just compare and contrast some of the companies that delivered and those that didn't. Look at Xilinx, which exploded higher. Look at Intel. Look at Stanley Black & Decker, which was down 15%. Look at United Rentals. Look at Southwest Air. So it's really getting to be much more specific on stocks. Hopefully that's good for active portfolio managers.
RJ, what, in terms of this discussion we're having, what do yields tell us right now? I'm kind of shocked that we could even be talking about the R word with yields as low as they are right now. I don't know what happened to our economy that used to be able to support 5, 6, and 7% yields. I mean, we can slow down at 2.5% on Fed funds?
Well, good morning. As far as the yield level, a number of years ago, about 5 years ago, at the end of the taper tantrum, we had a discussion internally, and we felt the highest the 10 years probably going to go is 3.5 or 4, and we might be lucky to get there. Productivity is still low. Demographics have slowed. The developed world doesn't have the same potential growth trajectory, and there's plenty of debt out there. So the higher the lower level of nominal rates that you alluded to is more burdensome, more binding in a slow growth, lower inflation world than historically the charts would suggest. We hit 3.25 in November, and I think our thesis in the near term proved true. It took years to get there, as you know, but risk assets couldn't handle it. There were many other challenges, in addition to rates, of course, that had to do with the fourth quarter, but clearly higher nominal rates relative to history are unlikely. Lower are more likely, and a deceleration of growth is what we're facing as we go into the new year, 2019.
What do you expect to hear from our friends at the Fed, Jay Powell, this week, RJ?
I think it's very clear they've called off the dogs, if you will, on rates. Interestingly enough, the market has focused so much on the balance sheet, it's sort of dragged the Fed into the discussion. There have been plenty of media articles about it. Chairman Powell's talked about it. I think it's very likely it'll be a key topic in the post-meeting press conference. I'm not sure they're poised to make a change just yet. But they went from autopilot to being flexible extremely rapidly. Maybe QE, which helped to lower rates and propel risk assets on the way up, is now realizing itself in reverse. And QT, in fact, does matter. And so some signaling on the balance sheet is probably very important. The idea of where is it going has not been defined by the Fed, and I don't doubt we'll see more discussion around that variable. How small or how large relative to history will the balance sheet be when they finally decide to sort of level it out?
So what's the most attractive part of fixed income right now if I needed to put it into my portfolio just to minimize my equity exposure? What should I do? Munis or corporates or junk or what?
Well, interestingly enough, after the tumult of the fourth quarter, we felt that was overdone. Holiday period markets allowed for exaggerated moves. We thought rates would retest higher after hitting around 255 on the 10-year. That worked. We positioned for that. We felt spreads had gotten too wide, that the economy is not recession likely in 2019. Those spreads also came in. We positioned for that as well. Going forward, it does get a little tougher. It's a very good question you're asking. I think with yields close to 3% on the 10-year Treasury, with yields reset higher over just 2-3 years ago, that it probably does make some sense to introduce some higher quality fixed income into your portfolio. We still like taking credit risk, and we're still overweight high yield, but to a much lesser degree than we were, say, 3 or 4 years ago. We are not in the recession camp, and we also don't think rates are apt to break sharply above 3 anytime soon. If anything, we might get a slow bleed a little bit higher, and then there's a lot of uncertainty. The China-U.S. Stands out as probably the biggest one. The Fed's balance sheet is yet another. So at this point, fixed income as a diversifier to your equity portfolio, even of the high-quality variety, like munis, like you mentioned, really can make a lot of sense. And I think people should stop fearing duration.